If I handed you $5 today, you barely notice. But if I handed you the same $5 from 30 years ago, it could be worth hundreds or even thousands today. The difference isn't luck, it's automation. Join us in the $5 decision as we explore the power of automatic investing. We ended the last episode with a balance of $90.06, which consisted of $90 of our own investment and capital gains of 6 cents. As of today, the market closed and the current price of the Vanguard 2050 Target Retirement Fund was $59.89. With the $90 investment we put in, we did have a capital loss of $1.37, giving us a balance of $88.62. Right now, the most precious thing we have is time, and we want to continue to build our account as our army of dollar bills grows. In order to build our army of dollar bills, we'll be talking about the power of automation. Most people don't fail at investing because they don't make enough money. They fail because they forget, they hesitate, or they panic. Today I'm going to show you how automatic investing removes you from the equation and why that's the real secret. This chart here shows the percentage of people in each age group who use automatic investing, things like contributions to a retirement account or even an investment account. What's interesting is it's not the youngest group that uses the automation the most. 18 to 29-year-olds are using it about 40% of the time. A lot of them are still trying to get around to it or get things set up. We're going to see why this is such a big priority to get this started sooner rather than later here in a minute. 30 to 44-year-olds are the highest. Why is that? This group leads the way with nearly 60% because life gets busy. They don't have time to do individual investing or remember to invest each month. At this age, you're probably starting a family, you're buying a house, you might even have kids. Life gets in the way, and so you need to try to keep it simple and get your investing done on a regular basis by automating it. 40 to 59-year-olds, it's still strong, just over 50%, but if we notice, it actually starts to drop. And by age 60, it's down to about 35%, I'd say, as many stop contributing or start making emotional decisions that go towards retirement. The takeaway isn't age in this, it's behavior. The people who automate the most are the ones who stop overthinking and just stay consistent in their line of thinking. Automation removes fear, hesitation, or procrastination. You don't wake up wondering, should I invest today? It just happens. The market rewards consistency, not confidence. And this is exactly what the $5 decision is about. It's about small amounts done automatically, be big decisions made emotionally. This chart shows the impact of long-term investing as well as the emotional aspect that goes into it, right? This assumes a $500 a month contribution with a 7% annual rate of return. And what we see is the blue line is the automatic investing where the money goes in every month, and the orange line is our manual or inconsistent investing, maybe skipping months, waiting for better times, reacting to the news in the market. If we take a look at the early years, at the beginning, these lines look almost identical, and this is why most people quit. They'll say it isn't working because they don't see the results yet. Ingredient of wealth is time, as we talked about in prior episodes. So we need the time to kick in. And where the time starts to kick in is right around years 10 to 15. Something changes. The automatic investor isn't just adding money, their money starts working for them. The returns that they're getting from their account are more than what the contributions they're putting in these years. So not only are you putting in money, your accounts are making money for you. In the long term, by year 30, the automatic investor ends up with more than double the balance, not because they were smarter, not because they timed the market, simply because they stayed consistent, right? This is why automation is so powerful. Both lines are nice. However, the gap is created on both of these between the automatic investor and the manual investor by hesitation, by fear, and emotion. Automation removes that. This is why the automatic decision beats big emotional ones. $5 here and there doesn't feel powerful, but over time, it changes your entire future. We take a look at this. This chart shows how much $1 can turn into by age 65, assuming a 7% annual rate of return. This isn't really anything fancy, no market timing. It's just the time that $1 is in the market. If you take a look at age 20, $1 can turn into over $20 by retirement. Let's let that sink in for a second. If we take a look at the current age groups 25, that same dollar is going to drop to about 15 times, about age 30, 10 times, age 45 times, and age 55, barely 2 times our money is going to be gained from that $1. The key lesson that we need to take away for this isn't about being young. It's about how long your money is allowed to work for you. Automatic investing buys you time, even if you start small. Every year you delay doesn't just cost you money, it costs you multipliers. And we need to be very cognizant of that on our journey. So to drive this point home just a little bit further, we're going to have Jumpin' Jake and Eager Erica. And we're going to do our own study to see how their decisions impacted the amount of time they spent investing. So we're going to use Jumping Jake. Jumping Jake's going to every week pay himself $50. That's going to be $217 monthly into his retirement account using a 52-week year. Jumping Jake is 36 years old, and we're going to assume a 7% rate of retirement. When we put this in bank rate calculator, it's going to calculate the compounding interest for us. It's going to kick back that at Jake's ending balance at retirement is $151,000. That's 24 years in the market for Jake. Jake has capital gains of $88,996, and he used $62,000 of his own money. So he made a little bit over one time his money in the market. But as we're going to see here very, very shortly, how much the extra time in the market does matter when we get to Eager Erica. Now we have Eager Erica. Eager Erica is going to start a little bit earlier at age 26. All the other assumptions will be the same. $217 a month and a 7% rate of return. Erica's ending retirement balance, though, is going to be $333,986. Why is her balance so much higher than Jake's? She was able to continue to let compound interest work for her. She was able to put $88,000 of her own money in and get $245,000 in capital gains. So the lesson we again learn from Eager Erica and Jumpin' Jake is the time in the market matters. Trying to time the market does not. Applying what we learned, we're going to take emotion out of the equation. We're not going to ride the waves. We're not going to get too high with the highs or low with the lows. When in doubt, we're going to zoom out and we're going to automate. Markets do rise over time. And you could take a look if you go to Google and just type in S&P 500 and you look at the 1 year, the 5 year, the 10 year, the max. Markets will continuously rise. We're going to pay ourselves first. And by doing that, each 15th and the 31st of the month, we're going to deposit $108.50. This isn't enough for us to retire, as we saw from the examples, but this is a nice start. I don't think it's an unrealistic example to pay ourselves that much. I think each person that watches this hopefully can make those contributions. I do know life is tough, but we're going to try to make those contributions. The remaining contributions that we make, we're going to try to find money from the different life decisions that we make and the savings in those. So by maybe trying to save $5 here and there, continue to build our account balance and continue to grow it. As we end this episode, our Vanguard Target Retirement Fund, we've contributed $90 of our own money. The price did go down to $59.89 as of today, giving us a capital loss of $1.37. So our current price is $88.62 of our account. But as we saw, we're not going to get too high with the highs. We're not going to get too low with the lows. We'll continue the automatic investing and growing our account each day. This is the $5 Decision. My name is Ryan. This is my personal journey. I'm not a financial advisor, but as I continue to invest, I would like to share that journey with you. Please like and subscribe to help keep the series going. Comment if there's topics you'd like to see me cover in future videos. Thanks. Have a great day. Bye.